Hi, Matt McAleer, July 15th, just before the close. I'm Director of Equity Strategies. I'm with the Moose, CEO and Head of Fixed Income. I'm going to share some thoughts, share some ideas, take a look at what might be working, what isn't working. In terms of equities, I'll jump in first before we shoot over to fixed income, Moose. Couple things to like this week. Again, there's plenty not to like. And those are the headlines we're seeing every day and the volatility we're seeing on a daily basis. If we're going to pick out a couple of items this week just to keep an eye on going forward, is the fact that we did sell down hard Thursday, post that ugly hot number, inflation number. And I don't think it was an accident that we sold down to those June lows.
But not through them.
Not through them. So there is still some demand there. That doesn't mean we just start buying into that pullback. As our clients know, as you know from my conversations here over the last couple of months, we have a decent cash position in our equity accounts, depending on the strategy, somewhere between 20 and 30% or so. We've been very patient with that capital. It's difficult to be patient in volatile times. Sometimes you feel like jumping through the screen to be a buyer. But in terms of what we're looking at and what we're seeing, we're trying to pay attention to sectors and industries and specific stocks that are putting in a base or have a long sideways movement to them. I think people have gotten used to 10 years of loose Fed, and when the market sold off, it would sell off hard, John, and then V, bottom, and take off.
And there's a lot of people on Wall Street who never been through a hard Fed.
I was going to say, we've been through enough of these markets, and if you want to go back to 2000, 2001, 2002, 2008, 9, where the Fed didn't have your back to the same extent as you saw in 15, 18, COVID. And in those periods, we want to look for bases. It's very tempting to jump in and buy what's been hit hardest.
Right.
But instead, what I prefer to do here is see what's hanging in the best. What is having to be pried out of people's hands. And those sideways bases in markets going back into the 90s and early 2000s are what created your next winners. So I just wanted to share a few thoughts, share some names with you, and then we'll shoot over to Moose. Just in case people are throwing their hands up and saying nothing's working. I'm with you. Very little's working. Let's take a look at a couple things that we have our eye on at Cumberland. Let's look at ETFs first. I've been mentioning healthcare. Healthcare trades dry. What do I mean by dry? Opposite of damp, opposite of wet. When healthcare pulls down, there are buyers. Watch what's greenish, watch what pops first in bad markets. Pharmaceuticals, drugs. The other thing you have to keep an eye on, the worst performers acting the best now.
Right.
And that's biotech, alternatives. Let's look at some individual names. Pull up on your screens if you're home or if you want to do a little work. Starbucks, McDonald's, Cigna, Progressive, Waters, WAT. I'm trying to use different industries here. You want to look at smaller or mid-cap? Belden, BDC, Cabot, CBT, chemical company. I'm pulling those out to just show what we're looking for in terms of patterns, a broad basing pattern. So that's it for my soapbox right now. We'll keep looking. We'll get that cash. I guarantee you there's opportunities that when we look back in 12 or 24 months, we're going to say, how couldn't I bought that?
Right.
So we want to buy it. We're just being a little patient. What do you got, Moose?
On this end, different kind of week. So you have the CPI comes out, surprises on the upside. 103, the market was expecting 101. Still a big number. Don't multiply that by 12 and you're throwing your hands up. There's no question that the markets take that and say, wow, the Fed is going to be serious. It's going to be 75 basis points next hike, another hike, maybe a point. And the idea is that the Fed is going to put the screws on inflation. That comes at the expense of a few things. And some of that is spending, some of that is jobs. Certainly you look at things like wage growth versus inflation has been down. So you're in this market where the bond market is now anticipating a slowdown. How do you tell that? Look at the 2-year bond at a 313, up a few basis points this week. Look at the 10-year bond at a 292. That was down in basis points this week, about 15 basis points, along with the 30-year bond
You'd
to a 3.
never guess that. If
you wouldn't guess that
right?
when you look at a high inflation number.
Right.
That is also a negative yield curve. That tells you that the market is starting to lock in longer-term yields. Doesn't mean they can't fluctuate around. We've talked about that before. But they see the market slowing, basically the economy slowing down, and they want to lock in yields now. And that is obviously telling you that the market believes inflation is going to come back to a more normal range. The question is how fast. That's going to, of course, depend on the Fed. From our perspective, one of the bright spots this week was in Muniland, where we've talked about how bond funds have been decimated with liquidations. That's, of course, created this large 4% plus opportunity that we keep talking about ad nauseum and embracing, I might add. Well, this week we had about $200 million of inflows into bonds. That doesn't sound like much, except last week was $300 million of outflows. But even that looks good compared to some of those weeks where we had outflows of $4 and $5 billion.
Yeah.
So I'm not ready to say the worm has turned, but from the bond market's perspective, things have started to settle in. We don't know whether we've seen the highs in yields so far this year, but the market's saying we might have.
You know, that's one of the 3 triumvirate, right? We needed to get interest rates under control,
Right.
oil under control, and the dollar under control. Interest rates are starting to behave. Oil, while very volatile, back under par, back under 100. Whether it stays there, that's a guess at this point. But it's better than 120 a month ago.
Right.
The dollar, troublesome, keeps making highs against the currencies around the world. That does pinch some of
parity on the euro.
It hasn't been for how long?
20 years.
20 years. So you're back to where, and you remember when it was, euro was 120, right?
Exactly.
120. So we've got to keep an eye on a dollar. That continues to be a thorn in our side. But again, we don't get too high. We don't get too low. We'll get through this, just like we always do.
Right.
We'll get through this with some fine opportunities, and we'll take it a day at a time.
Exactly. We feel a little better.
Okay. Have a great weekend. Don't forget to like, comment, and subscribe so you can follow along with our weekly videos. Enjoy yourselves.